Hi, Greg Weldon back at you with episode number 4 of Money, Markets, and New Age Investing. And as I'm sitting here just kind of doing my normal thing, looking through charts, it's been kind of a slow start to the year in terms of the markets. A lot of choppy price action, but it is no slow start in the sense of economic data, particularly from the U.S. We see housing numbers which have been atrocious. The service sector numbers, atrocious. You want to talk about recession? I mean, you can make a case that we're already in a recession. But the numbers that have caught my eye in the last 2 weeks have been more along the government debt dynamic. The UK just had the largest ever single month public sector borrowing requirement number, almost 30 billion sterling in a single month. That's just a massive number. It's something like we've never seen before, and they've been running massive numbers. And then for the U.S., I just decided to look what's the most recent, monthly numbers look like in terms of the budget deficit, in terms of public borrowing. And the dynamic around public debt right now, in the last 3 months, it has increased at an annual rate of 2.499 trillion, 2.5 trillion over the next, 12 months, over the last 12 months. It's the fourth highest, year over year rolling 12-month total accumulation. Outside of the 3 months that we saw during the height of the pandemic. I mean, we're back to like pandemic levels of spending, pandemic levels of debt creation. Not only that, when you talk about inflation, when you talk about the consumer, we know 6 trillion in savings, gone, back to like 1 trillion, back to where it was before the crisis. It's actually lower now than it was before the crisis. Savings gone, all right? Wages don't keep pace. Your paycheck is worth less the second you take it to the bank. The second you get issued that paycheck, it starts to deteriorate in value in terms of the purchasing power of that money you're getting paid. We know that as well. And then in terms of debt, I mean, record credit creation here in the U.S. on an unprecedented scale in consumer credit. The Fed's numbers are off the charts for this, record after record after record. I've detailed it month in, month out in terms of the monthly numbers. I mean, you're talking about 5 months above 30 trillion when you've only had like 7 months above 30 trillion in the entire history of the number. And you're talking about, maybe once in like 1990s, and there was a couple around 2006 and 7, and then bam, a whole slew of them because people having to borrow just to pay the bills if you're at the lower 2/3 in the income scale. But all of this and the, kind of all the political scene kind of masks the fact that we're still running this huge deficit that is publicly funded. All right. You're talking about, public debt is now over 30 trillion in the U.S. Finally got above 30 trillion. We knew it was coming just from all the spending that was done during the pandemic. But you are there now. And when you start to break it down, the problem with going from a secular 4 to 5 decade trend where you had ever lower interest rates and ever lower inflation to the opposite, higher lows, higher highs. Yes, inflation is going to come down. That's going to cause the Fed to back off and at some point reverse their policies when the economy is clearly going to be in recession. I don't think there's any doubt about that. We talked about the triple play in recession. You have these 3 things together. You've never not had a recession. Food at home inflation above 6% year over year. It's been double that, and it's still in double digits. The yield curve inverted. It's been inverted to the degree that we haven't seen since the 1980s. And then the third thing being the dollar up 20% over a 12-month period, which it was. In fact, it was up 30% relative to gold in a 12-month period. And that is unprecedented in terms of talking about a triple play, talking about a hat trick. In this case, it's a grand slam because you have four of those factors which say a recession is coming in 2023. Certainly, the thought process around the stock market is hopeful that you get a soft landing, hopeful that the Fed is able to pull this off. I mean, come on, the Fed be able to pull this off? They're walking across Niagara Falls and on the tightrope. They're trying to do a Nick Walenza or whatever the tightrope guy, right? Walking across Niagara Falls on the tightrope, you bounce the beam one way too far hawkish, boom, you fall off. You bounce the beam a little bit too far the other way dovish, you fall off. Either way, it's almost a losing proposition. Damned if you do, damned if you don't. The bottom line, though, is the debt. It keeps getting lost in the equation, the degree of debt that we have here. And what made me really start to think about this in an odd, roundabout way that you're going to just love. I know a lot of you will love this when I say this. A lot of you will hate this when I say this. Because it turned bullish on Bitcoin and Ethereum this week. And there's a whole thought process there, which I will get to at length in a minute. But the basis is the debt. The basis is the depreciation, devaluation, and debasement of the value, the purchasing power of paper money, wealth, and income every single day, whether it's through inflation, whether it's through central bank money printing. All right? When we talk about the debt, it's inevitable because the only way out is to kind of reflate your way out at this point. We've been going all this time worried about the debt deflation, and you still have to worry about that. But the bottom line is the debt is enormous. Let's talk about it. I call it the royal flush. And I'm going out on the speaking kind of tour in the next few months and trying to come up with catchy, titles for speeches and ways that you can make this tangible and visible and, something that people can actually, kind of gutturally, they know it. They know what's going on. You know what's going on. You know your money's being debased every single day, but you can't put your finger on how to describe it or what to do about it. And that's why we're here. I mean, we're describing it for you right now. I'm going to tell you what to do about it in about 2 minutes. All right. But describing it is the royal flush. It's the royal flush of debt. It's a winning hand. You can't beat this hand. An ace-high royal flush is an unbeatable hand. All right, you could tie it with another royal flush of a different suit, and then people would debate what suit wins. All right, but that's not a debate. Okay, it's a split pot. But either way, when you talk about the royal flush, it's 5 things. Okay, and really 6 because there's an ace kicker in addition to the 5 cards you're going to use to make your hand. All right, so you have a royal flush with an extra ace on the side. All right, it's a game of 6-card poker. Because you have derivatives, number 1. Public debt, number 2. International dollar debt, number 3. Central bank balance sheets, number 4, which is kind of a derivative of public debt, but we won't look at it that way. We'll give it its own category because we can measure it and watch it. And then private debt. And now private debt includes unfunded pension liabilities, which is a huge problem that, people talk about, then they don't talk about, and then you don't hear about it for a while. And let me tell you something. In the next phase of what's coming here, stock market returns being down. You've already had the worst year in history for the 60-40 portfolio split. Pension funds are choking, man. And places are either going to start laying off police and services, or you're going to have more and more, bankruptcies and, even muni bonds now could be called into question by all of this. This is kind of, second step, not quite there, but awfully close to where that's going to be happening. But let's talk about the 5 things, the royal flush of debt, the unbeatable hand that will be laid on the table and everyone's going to have to pay. Everyone's going to have to chip money into this pot, man. All right. Derivatives. If I told you the amount of derivatives right now that are outstanding on bank balance sheets, Bank of International Settlements data, I watch this all the time and I did not realize that it topped this figure I'm about to say, is over $600 trillion. $632.24 trillion in derivatives out there. Okay. You go back to it was 2007 and 8. It wasn't far off this, but if you remember, the derivatives for trading purposes, okay, is really what you look at, which is the bulk of them. All right. And of course, fixed income is always the top holder in terms of derivatives. And a lot of it is hedging, but only about 12% of it's hedging. About 88% of it is for trading purposes, i.e. trying to make a profit, speculating to the tune of, $500 quadrillion in derivatives, $500 quadrillion of them alone in fixed income. All right. $110.4 trillion in foreign exchange, including gold, commodities, $3 trillion, 2.96, and equity, $7 trillion at 6.99. I mean, think about that, man. I mean, FX derivative risk alone is $100 trillion. There's not a central, that's, what is that, 10, it's going to be about 14 times the Fed's balance sheet. I mean, it's insane. It really is. That's just the derivatives, $632 trillion. More than any central bank could ever bail out, okay, let alone now that Bloomberg recently ran a story about a missing $65 trillion in dollar derivative fixed income, dollar debt, essentially, derivatives. $65 trillion. That alone would create a complete financial panic. $65 trillion. Gone, not being counted on the balance sheets. So let's say there's 10% more on top of this $632 trillion. You're talking about almost $700 trillion in derivatives out there. $700 trillion. $700 trillion. That is an unfathomable number. And it makes public debt look small, but public debt is not small. All right, U.S. public debt alone is $30 trillion. That is our debt as U.S. citizens. All right, the government, it's not the government doesn't know that money. We do. And this is why it's so, paramount now in terms of, all this spending that the government's doing, as if, hey, the printing press just runs all out. There's never a piper to be paid. Well, I'm sorry, that's not necessarily the case. All right, public debt in the U.S. is a problem. International dollar debt is a problem. They're talking about, somewhere that's around 30 trillion. Central bank balance sheets, $8.5 trillion in the Fed, $8.5 trillion ECB dollar worth, $5 trillion worth BOJ, $6 trillion worth PBOC between the top four alone, not including the Bank of England, not including the Bank of Canada, not including the Bank of Australia. All right, 30 trillion right there. Turn around everywhere, it's 30 trillion, 30 trillion, 30 trillion. Pension funds are at least double, if not quadruple that. Man, that's a lot of debt. All right? It's a royal flush when you take private debt, when you take consumer debt, when you take corporate debt, and then you throw the pension liabilities in on top of that, man. Think about the people that are going to lose their pensions. Think about the people where the pensions payouts are not going to keep up with the cost of living. Cost of living, most of those increases were taken away as a way for, the government to save money so they could borrow more was by, there's no inflation anymore. So let's just take away cost of living increases. Now, all of a sudden, you got an 9% inflation rate. You need a cost of living increase or you're going to be falling behind. You want to talk falling behind? Let's talk falling behind. Because what you're seeing right now is every currency on the face of the planet is being devalued relative to its purchasing power. The single best, most reliable, easiest, and frankly, just the best way to do it is through gold. An ounce of gold. What's the currency? How much of a currency does it take to buy an ounce of gold? It's the ultimate kind of measure of a currency's purchasing power. If you could buy this much of gold, it used to be a suit. What was a suit? And turkey dinner. What's Thanksgiving dinner? We're going to measure the purchasing power of the dollar. I've talked about the purchasing power of the dollar going back to the 70s relative to an automobile, the most popular automobile now versus then. Okay? I've taken it in terms of a certain square footage of an apartment now versus then in New York City. What's the devaluation in the purchasing power of your dollar? Gosh, you can just say alone. I used to go to Yankee Stadium when I was a kid, and we would scalp seats, and we'd get box seats for a doubleheader against Cleveland because they were the two last place teams in the East. Last place, okay? Roy White, Horace Clark. We used to love Roy White, for one. Joe Pepitone was always a favorite of mine. Bottom line is, it was $4.50 for a box seat right behind the dugout. $4.50. Think about what it costs now. It's a couple $1,000s for that seat. That's the decline in the purchasing power of the dollar. It's that simple. And it goes on all the time, and it's intensifying because of all the debt. Let's take a look at some currencies, and let's go back to the year 2000, all right, which was the debt bubble peaked, and then all of a sudden you had kind of zero rate. ZIRP was introduced before even QE became a thing in 2009, which I said would be a thing in 2006. When I said would be a thing in 2007. When I said would be a thing in 2008 and got laughed off the set of CNBC Squawk Box and called the nut job for having proposed such a ridiculous thing that would never happen. Of course it happened. All right? And what we're in now is even multiply effect times 100, if not 1,000, where we're going. Just back to 2000, last 22 years, relative to an ounce of gold. Here is the depreciation in the following currencies. Swedish krona, 90%, 90.0. British pound, 90.6%. Euro currency, 87.9% depreciation in their currency against an ounce of gold. Okay, the Japanese yen, 90.1%. Okay, Canadian dollar, 85.4%. Aussie dollar, 86.3%. All right, come down to where now the dollar is, 87.4. What's better than the dollar? The renminbi, 84.9. The Sing dollar, minus 84.1. And best of all, best relative performance, the Swiss franc. The Swiss franc devalued by only 80.2% since 2000 in terms of how many francs it takes to buy an ounce of gold. I mean, hello, McFly. I mean, these are the real numbers. I did them by hand for this podcast specifically. All right. Not only that, every one of these currencies except the dollar is making a new all-time low. And if you think, I mean, the Swedish krona 90, British pound 90, Japanese yen 90, then Canada 85, Aussie 86. I mean, talking massive numbers. But let's talk some emerging market currencies. And if you remember our first podcast, in 2022, there were 27 emerging market currencies that set new all-time lows or new multi-decade lows against the dollar during 2022. 27 of them. 27 currencies made new all-time or multi-decade lows against the dollar. Let's look at some depreciation in some, semi-popular emerging market currencies. And I use these currencies for a reason. Okay, Colombian peso. All right, since 1998, down 95.9%. All right, the Brazilian real, down 96.8% since 1998. Since 1998, the purchasing power of the Russian ruble, down 98.6%. Think about that if you're in Russia and you have all these rubles, and guess what? They buy half of what they used to. The Angolan kwacha. And the reason I like the kwacha, Kwanzaa, there's a bunch of them in South Africa, near South Africa, because Angola, like the Nigerian, the Nairu, okay, another one to do, okay, is an OPEC member that pumps out like 1.7 million barrels of crude oil a day. It's not a chump change country in terms of the potential economic vis-a-vis the resources there. But the local currency is down 92.1% since 2008. Down 92%. Now, two more that are very popular and populous. The Indian rupee, okay? Billions of people live in India. Their currency, since 2000, is down 93.1%. And since 1974, the Indian rupee, the purchasing power of the Indian rupee, the amount of, the ability to buy an ounce of gold, down 99.1% since 1974. You think that's an odd man out? It isn't. Since 1974, the purchasing power of the Mexican peso is down even more at 99.8%. And down 93.7 since 2000. Indian rupee down 93.1 since 2000. Over the last 20 years, 93% on both of them. 99% since 1974 on both of them. And the thing is, they can go down another 90% because it's an ad infinitum game, and you keep going down 90%, and then you're at 0.999. You go down another 90%. That's you're at 0.111. Then you go down another 90%. You're at 0.0001, whatever. You can keep doing this game forever, theoretically. Of course, then a loaf of bread costs $50. And that's a tagline I've been using since 2008. At some point forward, you can print all the money you want in the world, but at some point forward, you're going to have a problem where a loaf of bread costs $50 and everything's going up, and you're in an Argentinian-style situation where the purchasing power of every currency on the planet right now is under this influence. Every currency on the planet. I mean, the Canadian dollar just made a new low relative to gold. It was like one of the last to go. The dollar is among the last ones. There's a couple other Czech koruna. There's a handful. But most of them, when you got the Sing dollar, which is really the dollar of Asia, and the Chinese renminbi are in play at new lows relative to gold, that says all you need to know about the Far East. Certainly the euro, sterling. I mean, euro's down 87. Euro's down 88. Sterling's down 90.6. Even the dollar down 87.4%, and it's the only one that's not at a new low. So when you talk about the purchasing power, the erosion of the purchasing power of your currency, all right, this is what we're talking about, man, where, you buy less, and this is a problem. Now, one of the things we're doing, too, and we manage money here, and I don't advertise it because we take only from accredited investors. I have to know you. It's not something I advertise. But having said that, we've done very well with the methodology that we use here, which is to be involved on the long side, the short side of everything, commodities, currencies, bonds, and stocks. That's how you beat what's happening in terms of the devaluation, debasement, and depreciation of the purchasing power of your wealth, of your paper wealth. is you have to have it actively managed or actively traded in a variety of things. There could be long and short. It's the only way to keep pace. Just buying and holding stocks is no longer going to keep pace. You might have decent returns, but the problem is when you're in a situation like Argentina, the stock market is always at a new high. The Merval in Argentina is like always at a record high. But the amount of money that it would buy to own every stock doesn't get you as much other stuff if you were to buy something with it than it used to. All right, so the purchasing power is not at a new high, okay? The standard of living is not at a new high. And that's like a Venezuelan style, Venezuela's to the nth degree, but that's, it's just a softer Venezuela, really. And kind of like, we're talking about it being a harder U.S., where the U.S. is the softer Argentina already. And that really is, it's a dramatic statement. It's going maybe a step too far for right now, but it's not a step too far for a few years from now, from 3 to 5 years from now. That wouldn't be a too far statement. Maybe it is right now, but that's how we roll here. We tend to think 3 to 5 years out. All right. So I can tell you in doing the methodology that I use, which is not a active trading, we want positions where the macro is in line with the technicals, the quantitative, very risk management orientated to the point where it's very difficult to manage risk. Our managed accounts are $1 million minimum. Why? Not because I want to manage a lot of money and have less clients, or because $1 million is a nice, money to have in terms of, charging a fee. It's because my risk metric is 0.4% on an individual trade risk, which means $1 million, $4,000 per trade. You can't even trade some of this stuff anymore for $4,000 risk. And I use the risk is based on, where I'm going to be wrong, not how much money there is. So I back engineer everything. All right. I want to be long something. All right. Here's where it is now. So I want to buy it. Here's my stop based on where I think I'll be wrong, based on my math, based on my numbers, volatility, support, resistance, and several momentum indicators all get thrown into the hopper and you come up with a stop. All right. Stop is in on every trade immediately upon execution of the trade. It's a must. You have to have stops. They have to be defined. And then based on where the stop is, I can say, how many contracts can I buy? If it's in gold, say, and the stop is $10 away, then I can buy 4 contracts because that's $4,000 to the stop. Okay. If it's $40 away, I can only buy 1. And people will argue, we can argue all day about what's the best way to do this. Position sizing and this kind of thing is probably the hardest single decision to make next to getting out of a profitable position. Okay. But this is more critical to your longer term success too. So in that vein, okay, I will tell you that our program, since I did the Age of Aquarius speech at the beginning of 2020, so starting in 2020, okay, we're up 66% after fees. Okay. We start looking at some of the other things right now that are, what are the changes in some of the other things? Well, Amazon, and this is as of 2 Fridays ago, down 14.4. The Canadian stock market up 15, NASDAQ up 26, silver up 33, the S&P up 20.4, gold up only 3%, and of course, we're up 66. Now, there were a couple of things that did as well as we did, and there was one that did demonstrably better. Tesla was up 151%, okay? So, but it had a huge drawdown, okay? Microsoft was up 31.9. Apple was up 70. Bitcoin was up 70. So Apple and Bitcoin kind of matched us, but the drawdowns were huge. Our drawdown, I could be wrong about this, but I believe I got this verified this morning, 11.4%. I mean, show me any of these stocks where the swings are less than that. All right. The point here is twofold. Number one, you can outperform the markets. You can, and you're going to have to going forward. Number two, where are we now? And where this whole debt thing leads me to is Bitcoin. And why do I mention all the performance? Because with Bitcoin, I'm actually kind of doing something a little bit outside my own box because I have to. Why? Because the contracts are so big now and the risk is so large that having 0.4 risk is very difficult on a Bitcoin futures. All right. The Bitcoin futures is 5 Bitcoin is the value of the contract. And at $23,000, you can figure that it's about $150,000. So I want a roughly 15% position. All right. And that would be one contract. The problem is my stop is like $2,200 away and on 5 Bitcoin, that's over 10 grand. What do I do? buy a mini Bitcoin? I don't really like that. I mean, there's a lot of micro and minis, and some of them are very tradable, including the Bitcoin one. But it's so small. It's 1/10 of a Bitcoin, or 1/5, one or the other. I think it's 1/10. It's 0.1 of a Bitcoin. So now I got to buy like 30 of them to get just 3 Bitcoins, or a third of a Bitcoin, or rather 1 Bitcoin, versus the 5 Bitcoins in the futures contract. Now, for anyone else out there, it's easy. Got $100,000, you buy $15,000 worth of Bitcoin wherever you buy Bitcoin, and you stash it in your wallet, and so on and so forth. That's easy. I also like Ethereum. I like them both. All right. I would say this, a couple of things in terms of the downside. Well, the low in Bitcoin's 14,925. All right. That's the November 11th. I think it was that day was the low. I don't want to risk that. That's too far, man. And I mean, is it a trade? Is it an investment? Is something going to hold? I mean, I am a trader / investor. So I want to hold this for a long time. But I also am looking to take a profit on it. I'm not looking to hold this for the rest of time. I mean, that's just not the way I roll in terms of our portfolios are active and they're not passive at all. All right. So within that context, I'd love to hold it for 3, 4, 5, 6 months. I'd love to hold it for the rest of the year and have it at, $72,000. All right. But the downside, 14,925 is pretty far. All right. If you start using some standard deviations of the hourly trade, or you start using, some of the intraday charts, you come up with a couple of levels just above 20,000. 20,400 was the low on the 18th. It was a reversal low too. I always like that. When you have an intraday where it's way up, then it's way down, and it finishes neutral, or it's back up the next day. Those are what I call swing lows. Those are always good to use. Point and figure charts would identify those, and I love point and figure charts. So you could buy Bitcoin right here, 22.5-ish, and risk, 20,000. And I think that's acceptable, and 15% allocation right now, and then with a sidekick on Ethereum, because I like Ethereum too. On the upside with Bitcoin, you get through 23,700. That's the 200-day moving average, and I'm using the futures contract, by the way. And 25,270 is the July 22nd high. And you get through there, you're going to 32,000. So I see a rally to 32,000 almost at a minimum, and that's a nice risk reward. 10,000, 12,000 on the upside with a $2,000 risk is a very good risk reward of, basically 5 to 1. I'll take that all day long. In terms of Ethereum, above, there's a very well-defined breakout pivot. All right. The 2017 is the August 15th high, and 1975 is the 200-day moving average. So, when you're talking around either side of $2,000, you could see that you have a breakout pivot for Ethereum. And I like to buy strength. I want something to prove itself. The downside is pretty tight at 11.79. I wouldn't want to see it get much below 11.80 on Ethereum, or I'd want to be out. And that's, that's a lot of money. Again, if you're buying it at 2,000, you're risking 11.79. But that's the low. So I have to check that. I don't even think that's right, actually. Let me see if I can do that while I'm still on, so I don't have to stop the whole thing. And I should be able to just pull it up and tell you right away whether that is correct or not. Hello. Yeah, that's not right. 11. That should be 14.79. So 14.79 is that level. Still, it's $500 away. But, I think the upside is pretty good on Ethereum. And I think that has a more robust underlying story with a better longer term dynamic than does Bitcoin. But what I like about Bitcoin is simply say, well, honestly, when you're talking about the debasement of the purchasing power of your paper, wealth, and income, Bitcoin is in the game. It's second to gold, in my opinion. I still think gold is the better champion of this. But I know there's a lot of places in the world where you can't just walk down to the local gold dealer and buy physical gold and silver. Where for a lot of people, having a phone, having a wallet, having the internet is all they need to do to buy Bitcoin in some way, shape, or form. And I really look, when I look around the world, when I look at every currency that I'm talking about, making a new low versus gold, like this month as we speak, with the kind of depreciation we're seeing of anywhere between 80 for the Swiss franc and as much as 94% in some of the emerging market currencies just over the last 20 years. And that's accelerating now. We know it is, because mathematically you have this much debt next time around to print the same amount of money to get the same amount of economic effect to get us out of a recession. You have to print a lot more money, exponentially more money. And that's only going to drive inflation to a whole nother level. Yeah, inflation will come down. Inflation may go negative. Inflation may be deflation, and everyone will be screaming victory over inflation. And all of a sudden, the economy collapses, and you'd be begging for some inflation. They'll reprint, and you'll get it. And that's the dynamic we're in. And now it's more important than ever to protect yourself to some degree. And again, keep in mind, I can't recommend on a long-term basis anything if you're not there every day, and I'm not here for you every day. So, take that for a grain of salt. I could be out of Bitcoin tomorrow. Okay. I can change my opinion like that. I have to. Okay. But right now, what I see is a dollar that's in trouble. And it's not even just the dollar, it's every currency in the world, because you're heading into a global recession, places that it's much worse than the U.S., where food prices have been 30% or higher year over year, where people are really literally choking. And when you have those places, all of them in recession and all of them trying to work it out vis-a-vis currency printing and currency depreciation, you're going to see that the metals here, gold and silver, some of the industrial metals still, even the energy right here, Brent crude oil breaking out. Okay, gasoline looks positive. All the swaps are very positive. All right, even the industrial metals, there's no copper around. There's no tin around. There's no zinc around. There's no nickel around. And yet these markets are priced as if there's ample supply. They can actually absorb a demand hit and still perform very well. Same with energy. So you have an interesting dynamic here of potential stagflation down the road, where again, having protection is going to mean doing something more than you're used to doing, and to either get involved in the commodity and currency markets or find a CTA that can do it for you, that has a pool that can take in less money. We're not the guy for most people out there, and we're not here to advertise that business. All right, that just is fine with us, and we're very happy managing the money of the people that we know, that understand what we understand about the markets and the risks and the whole 9 yards, and can actually afford, to play the game, because it's very difficult, at certain price levels to get involved. But at the same time, you have to do it. You can use ETFs. It's a great way. It's one of the things we're trying to help you do here too, in terms of some of the ETFs you can use. So we'll talk more about that. There is an ETF for the Bitcoin. I think it's BITT, is it? Hold on. I will actually bring it up right now, because I have it here somewhere in front of me. We'll be able to pull it up. It is the BITO, actually, BITO, and the Ethereum is ETHH. That's a Canadian ETF, but again, so in terms of our recommendations here, kind of officially through the podcast, as it were, I just think it really behooves people to take protection in their overall portfolios, their overall wealth, their overall nest egg, to own some gold, to own some silver, to maybe own some mining shares, and to own Bitcoin and Ethereum, among other things. We still like the gasoline market too, by the way, which is UGA is the gasoline ETF. We talked about that as well. Soybean market's still a good one. SOYB is one of the other ETFs. We like some of the currencies. We like the Mexican peso, Canadian dollar. Those both have ETFs. I know the Canadian dollar does FXC. So those are some of the ways you can, take protection here. And I think going forward will be ever more important, and would be really interesting to see how the economic numbers tail out from here in terms of the employment numbers that the Fed needs to see to finally take their foot off the brake. And then we'll see if all heck breaks loose, because frankly, could it be a melt-up scenario on some of these markets, including stocks? It very well could be. I don't think the Fed would really like that. I don't think the Fed wants to take their foot off the brake here when the stocks are here and see stocks reflate. But the thought process would be that could happen. You see a rally, you suck everyone back in, and the economy pancakes, and the stock market reacts, and commodities don't come down. That would be really interesting. Again, Greg Weldon, thanks for joining us on episode 4 of Money, Markets, and New Age Investing.